When should you not invest? We are investors and always will be, but we don't just blindly ignore the world around us.
There are definitely times and situations when even seasoned investors should shy away from a stock market, run from property traps and avoid online lending platforms. But when and why? Let's check it out. Welcome to Money Unshackled, the investment channel that sets you and your finances free. This is Andy, I'm Ben, and if you like what we say, hit the like button and click subscribe. Let's get into it.
When you owe money in debt. If your net cash is negative, meaning that you owe more in short-term borrowings than you have cash in the bank, then you should definitely not be investing.
We don't include here mortgages and student loan debt. This is what we class as good debt. Bad debt, on the other hand, is high interest short-term products like unsecured loans, overdrafts and credit cards.
The high interest payable on such products can kill you financially. Get them paid off, starting with the highest interest ones before you start locking your cash away in investments.
Before a crash. It would be nice to know exactly when the wrecking ball of change will next sweep through the economy. Then we could stop investing in the run-up to the crash, holding our money in cash until it becomes far more opportunistic to buy on the other side at cheaper prices.
It's almost impossible to predict when a market crash will happen beforehand, but better investors than us, or even luckier investors, have been able to time the market. In the UK, the markets are so pessimistic about Brexit that we almost have a self-fulfilling prophecy. Markets just waiting in stagnation for an expected crash. Markets tend to move in line with people's fear. The markets fear Brexit, and so we expect their fear to lead to a market crash in the short term following Brexit.
It's foolishness in our opinion, but people en masse can be very foolish. Should you hold off your investment until after Brexit? Maybe for lump sum investments. There's bound to be bargains available on the other side, but look close enough and you'll even find some today. But we advocate drip feeding money into the market on a regular basis to protect you from big negative market swings anyway.
When you need liquidity. Might you need your money in the next year or so? Then don't invest in assets such as stocks, property and funds that can go down in value in the short to medium term. For true liquidity, you should hold a reserve in cash, but those that are okay with additional liquidity risk could invest instead in moderately liquid assets that rarely lose value, such as peer-to-peer lending, although these can take a few weeks to fully get your money back. Check out the cashback links on our website if you're interested in peer-to-peer lending. There are hundreds of pounds in referral bonuses for you to scoop up when you use our links.
When I have been saving up to buy an investment property in the past, I have chosen not to invest my monthly savings into the stock market or peer-to-peer lending. Rather, I have held it in cash to be sure of its availability when it came time to purchase the property. Bear in mind that an investment property can cost well over £25,000 of initial investment. If I had invested in shares, a short-term market downturn could have worked against me when it came time to sell the shares and buy the property.
When you don't know enough. We have mixed feelings on this one. While you should always do your research and make sure you are aware of all the facts before investing, there is something to be said about learning by doing. Definitely don't invest big sums if you don't know enough about an investment. But we are in favour of investing very small amounts that are not material to you into new investments. We prefer to learn by getting involved. For instance, a few years ago I wanted to learn a lot more about Bitcoin, so I attempted to buy some, only to discover that the transaction costs were through the roof, making the currency uneconomical to be a mainstream currency.
It is also why my first investment property project was purchased 50% with a friend. We learnt so much more by doing than by reading books, but the point is, we had read those books.
Before a major political event. We kind of covered this earlier with Brexit, but there is a bigger political storm on the horizon, and that is the ever more likely prospect of a socialist bordering on communist government under Jeremy Corbyn.
If this guy does take the reins of power, which could be this year if the Tories continue to mess up our withdrawal from the EU, it will likely lead to huge market disruption. Labour under Jeremy Corbyn are anti-aspiration, anti-prosperity and anti-landlord. they would seek to knock down the buy-to-let investment market. We doubt that he would succeed, but we can certainly see that times getting trickier for property investors.
Meanwhile, the ideal time to buy shares could be just after a Corbyn election victory, just after prices have crashed and fallen. People and markets always go too far with their expectations of calamities, and we foresee a lot of investment bargains being created. It might be better to hold off from investing in the weeks running up to the next general election once it has been announced, just in case that markets fall so you can take advantage. But they might fall for genuine reasons. Socialism on the scale Corbyn is in favour of has never led to good things for economies.
If you are a gambler, gamblers should not invest. It is in their nature to lose. Investors seek long-term sensible returns. Gamblers only want a quick win. If this is you, stick to the casino.
If you think you are an expert stock picker, nobody is truly an expert in stock picking. We're talking about an ever-evolving market based on over 6 billion people whose opinions and actions are unpredictable and drive the price of shares in weird and wonderful ways. It's why we still listen to the market analysts. Things don't stand still.
If you think you are an expert, you will probably trade frequently, racking up horrendous volumes of trading fees in your attempt to beat the market. If you accept that there is always more to learn and you do your research, then feel free to invest like a champion.
Question of the day: what are your fears about investing? Let us know in the comments section. Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. If you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.